Good afternoon, everybody. I want to start by thanking you, audience, who have joined us today. The Brazilian American Chamber of Commerce of Florida and the Banking Finance Committee would like to welcome Dr. Chris Getze, our friend and my teacher at the Wharton Business School. Dr. Chris Getze has been on the finance department faculty at the Wharton School of University of Pennsylvania since 1997. He is academic director of the Jacobs Levy Equity Management Center for Quantitative Financial Research. He's also academic director of the Wharton Wealth Management Initiative at Wharton Executive Education. He regularly teaches investment management and co-created the first full course on hedge funds at the Wharton School. Also, he has been the academic director of a number of Wharton executive education programs. Dr. Getze currently research focus on various topics, including multi-factor models, wealth management, risk management, asset allocation, the performance of managed funds, including hedge funds, venture capital, and private equity, as well as other alternatives. He currently serves on the Intel U.S. Retirement Plans Investment Policy Committee. Also, he served on the Economic Advisor Board of NASDAQ and editor of the Journal of Alternative Investments. His research has been reported in the Wall Street Journal, New York Times, Financial Times, Forbes, NPR, NBC, and Squawk Box, and other media. Welcome, Professor Getze, to the chamber.
Thank you so much.
The floor is yours.
Thank you so much. Should I share my screen now then?
Yes.
Yes.
Perfect. Okay, great. Thank you so much. And then I'll also enjoy hearing questions and so on. Luis, thank you so much for having me. You are not just a student at Wharton, you're a lifelong learner, and we greatly appreciate our relationship over the years. It's been really nice. Can you see the screen, the share?
Yes.
Just to check it. Okay. Good. It's a pleasure to have a chance to speak with everybody. I'd like to do it in the following way. As I go through, because my view is that the most important thing here is your time, that anyone on the call can ask questions at any time, and we could use the chat box for that. I have it loaded here and feel comfortable at any point in time to do so. Appreciate that, and obrigado. So what I plan to do then is talk a bit about inflation and its implications. It's an auspicious day in some sense because we know what's going on in Russia and Ukraine, which is likely to be in an ongoing way inflationary. We already saw oil, for example, earlier in the morning was up about 8%. We expect some volatility throughout the day. We've already seen the effects on global markets. Russian markets are down double digits, as high at one point as 40% down. Interestingly enough, the NASDAQ was down substantially earlier in the pre-market trading and has come closer to flat, while the Dow seems to have retrenched and held some of its losses. The reason I mention it is, of course, because shocks to commodities like oil and wheat and corn, which Ukraine has a substantial role in with respect to global markets, is natural. But the other question is, what about geopolitical uncertainty, policy uncertainty, and so on? And what about its implication on investor sentiment and GDP, which comprises at least 2 or 3 things that we might expect the Federal Reserve to talk about in its shortly upcoming meetings later in March. There are 2 thoughts about that. In part, there are those who think that the Fed may be less likely to increase interest rates rapidly because of the issues of inflation. And there are others who think that it would move the other direction, in part because the economy is so strong. And so the Fed either would move more quickly to stamp out the increased inflation that we're now seeing, lest it become increasingly embedded in prices and in contracts and in menus, which is one of the typical big issues with inflation. Or whether the Fed would hold back because of the potential economic shock that goes along with the geopolitical shock. So I plan to talk about a couple of those ideas along the way, and then ultimately end up talking about markets, the implications for markets and portfolios. The background is the macroeconomy, which I'll start with, and then we'll talk about inflation, which is inexorably linked, finally ending up with some comments on markets, portfolios, and how to deal with this idea of inflation. We know that inflation is a natural part of the way economies work. An economy that has zero inflation is highly unlikely. A moderate amount of inflation seems to go with the kind of expectational formation that market participants have as they engage in trade, in production of supply of goods and services. And there's a natural level that seems fairly strong in the markets and in the models that we have. I used to work at the Federal Reserve in Washington under the Greenspan era, and we had a lot of talk about how to think about targeting interest rates such that inflation expectations and realizations are part of rules. And I'll talk about one of the rules later today, known as the Taylor Rule, which may have been abandoned by the Fed, but gives us a background about bias. The problem, though, of course, is that we look to be having both demand and supply shocks that impact inflation. Demand in part because the economy has been running very strongly and very well, having printed, with air quotes, printed a significant amount of money base, if you will. The money multiplier, the number of times, if you will, a unit of value like the dollar gets circulated in the economy as we print more money or as we have reserve operations and so on, supporting the money supply, has not been very high. But still, almost surely, even without the war in Ukraine and in Russia, we would see, some might expect to see inflation once we increase the money supply. We did that in 6 weeks. We printed, with air quotes again, about $3 trillion in 6 weeks. Maybe a little bit more than that. And globally, around the pandemic, and globally, we might have increased money supply to the tune of about $17 trillion, again, globally, in terms of levels. So that's a natural notion that we might have inflation. The other thing, though, is we also have had dramatic supply shocks. The supply chain is hampered. You can see it through a number of indicators, and I'll speak with you about it. Some of you, I'm sure, on this call are highly attuned to the supply shocks we have, perhaps being in the Florida arena. All you have to do is look at what's happening in ports, Miami and Houston and LA, in particular LA, to understand at least partially where some of the supply shocks are coming. It's interesting to know that lumber went up and came back down, highly inflationary, then back down, but there are a bunch of other sources of inflation, including the price of carbon and crude and complements, real estate as an asset, infrastructure as an asset class, and then, of course, labor by itself. So these fundamental inputs have had two kind of squeezing effects. We don't see hyperinflation, but we see inflation running hotter than it has for many decades. And I'm going to make an argument why that's really important if you perhaps haven't had that experience before. Now, to understand the experience in Brazil or the experience elsewhere around the world where we have had episodes of extremely high inflation, we all know that it's better than deflation. But it can be extremely challenging and expose us to other sensitivities. And some of those sensitivities can come geopolitically. And by the way, it's not just Ukraine and Russia. It's also Taiwan and a rumor that's been circulating. I didn't get a chance to check it for a second time before I came into the session today. But it looks like there's at least a chatter about Chinese warplanes around Taiwan. So, that's not necessarily unexpected either. But it's not, it may not be good for inflation on a global basis. We already know that in part because, as I said, crude was up 8% before the call today. So then the question is, what does it mean for your portfolios? What does it mean for businesses? How do business owners think? And so that's going to be the topic that we're going to go through. The first thing is that we've just come across, especially powerfully in the US, the best 13-year period in the history of the market in the US. And that's interesting in part because the largest firms in the US market are also the largest firms on earth. Referencing, for example, Microsoft, and referencing, of course, Apple, and firms that have somewhat unusually come to represent large portions of the market capitalization of markets. It's not unusual to have, say, the top 5 stocks in the S&P 500 represents 10 or 15%. In fact, more than a decade ago, we saw ExxonMobil and Berkshire Hathaway and Microsoft and a couple others would sort of rotate presence in the top 5 or the largest firm. ExxonMobil was the largest firm for a long time. But in the middle of the pandemic, the top 5 stocks in the S&P at a certain point rose to almost 30% of the index. So it became highly concentrated and was, again, the best 13-year history in those markets. And that was no different in a sense in 2021. There was a 29% gain on the S&P 500 with a total return measured including dividends. January, however, was a tough month, and I imagine that some of the volatility is going to continue. As an index, the volatility index known as the VIX, which you can put into Google and find, it measures, if you will, sentiment, or it measures current possible volatility in the market over the next month on a percentage basis. It was around 22 at the end of January. At the end of December, it was around 17, which is close to its long-run average. As of February 8th, it was down to 23. I just looked at it earlier today. It's around 30. During the pandemic, it was around 90 intraday. These are moderate numbers, increases, but the market's not pricing what's going on in Ukraine to the level of a pandemic or a great financial crisis. It does look like the cresting element inherent in what we see for the COVID numbers is mollifying before the most recent volatility of the market to some degree. Although the shock to GDP, or the underperformance of gross domestic product, both in the US and the world as a result of late 2021 increases in COVID cases, was clearly in effect against the background of GDP shocks. So what does that mean for inflation, and what does it mean for economic activity? You can't read one without the other. And of course, you can't read one without looking at what central banks are going to do, in particular the Fed, which has become so and remains so important in global markets. Again, the good news is that last quarter we had great GDP. And it was coming in at just about 7%. So the return on investments, the return on asset classes followed this path. You can see the VIX index on the graph in the dots. It was, you can read it off the right axis. It was coming into the pandemic at very low levels, not historical low levels. The historical low levels are around 10%. You can read it like a standard deviation. You saw it spike on the right-hand axis intraday to above 90, on a close basis above 80. And you notice when risk in the market explodes, the market here in the blue and the red, blue for the S&P, red for the world. So the blue is the US, large caps, S&P 500. The red is the world, not including the US. Well, of course, the US and the world became correlated. During the pandemic, the US pulled out of it, in part because of the tech revolution that was sped up by the pandemic. And the rest of the world came along, but it did so at a slightly lower and slower rate. And it's been fairly flat for much of 2021. International, you see a lot of flat volatility, but with the US continuing its run. Now, it doesn't mean the US didn't have volatility, but it's been a very good experience. The US economy, again, remains fairly strong. Some volatility most recently, in part because of the inflation numbers, but when we put it through our models for forecasting, the economy maintains a very strong position. And in fact, it looks like recession probabilities for the next 2 quarters are flatlined at 0. Maybe the challenges in Ukraine and maybe in the Asia Pacific region, we don't know. We'll see how the rest of the day and the next several days works out, is going to cause some changes there. But the economy is incredibly strong otherwise. So it's highly unlikely, in my view, that you're going to see a dramatic change in the economy. You may see slightly lower earnings. You might see more moderate GDP, both again in the US. You've seen that in the way the Conference Board has updated estimates. The IMF and the OECD have both come in with slightly moderated elements of GDP. So for example, IMF is coming in at just under 4% for global GDP, whereas for 2021, it had come in at 5.9. The COVID episode, I have a mixed feeling about. I made it for 2 years personally, Luis, without having gotten COVID. And then I came to Florida and I got COVID. So, but the good news is I think it was Omicron and it was short-lived, and probably that's good in terms of immunities, at least for a while. So this gives you a sense of it. This is the number of new cases on a daily basis in the US. Notice a couple things. Notice that this is for 2021, that cases were low and volatility was low. You can see the level using the red line. That's the 7-day average, and then the daily news. The daily new cases are in the blue. Notice how cyclical they are. You can see natural cyclicality in the cases and in other measurements on a monthly and on a weekly basis. Weekly, in part because people operate, week to week and weekend to weekend. And so we see spikes following weekend get-togethers. But the other thing that arose in the last quarter that impinged upon the supply chain as well as the economic GDP forecast, which were revised downward, was the volatility. Notice how the volatility is very high. It's indicative in a sense of one input onto uncertainty, right? That's the definition of uncertainty. You have large movements. Of course, there's cyclicalities because of the weekends, but that directly impacted consumer sentiment. It directly impacted GDP and ultimately feeds back into the what we thought the Fed would do. You can also see it, by the way, if you look at some of the big data estimates we get from in the top Apple Maps. This is literally people going to Apple Maps and asking for directions, either driving, using public transit, or walking. Now, public transit's interesting because it generally refers to people going to work and not necessarily just social activities, whereas driving and walking are more likely to be both, especially on the weekends. And you can see, once again, the cyclicality. The reason it looks like a sawtooth is that people love to go out on the weekends, especially for walking. But it's also true for driving, which is inherent. And of course, once again, the orange is transit. And you can see, this is at the very beginning of 2020, normalized to 1. We had the pandemic, we had a crash. We had a little bit of an unlocking. Then we had Delta. We had some unlocking. And now more recently, we have Omicron. Once again, the idea behind this great level of uncertainty is clear. We want 2 things. We want agency. We want to be able to go out. We're all sick of being quarantined, et cetera, et cetera. At the same time, we saw the cresting, or at least the increase in Omicron last year, even going through today, despite the declining levels overall. The increase in volatility is apparent for TSA screenings and in open table reservation requests in the bottom right. The good news is we had a flattening of the number of cases and a recovery, not entirely. And I don't know if you've had a chance to travel very much. I've been traveling a little bit, as I said. Airports, actually, I thought were very busy, but that in part could be because airplanes themselves and flights have been cut. So there's a lot of backup in the airplane, in the airports. And on the bottom right side, we want to go out. But the point is this: the volatility increased. And that has impacted economic forecasts to a certain degree. And again, uncertainty from sentiment perspectives. Now, the background behind all of this is that household balance sheets are strong. Now, this is a U.S. number, but it's important because it feeds back into the Fed's decision function. The blue line is the household debt service levels in the U.S. as a percentage of income, disposable income. And in the blue, you see debt service ratios. So debt service ratios have gone down. household is also nonprofit. It's aggregate net worth as a function of disposable income has gone up, and it's inverted going all the way back to the 80s, starting after the financial crisis, but really not, the main point is it's not reverting because of the pandemic. There's a lot of cash on balance sheets. Housing and manufacturing have come in very strong. REITs were the best performing asset class last year. We came in January at a very hot job number of 470,000 versus what was thought to be a moderated level of 150,000. There are a lot of jobs out there and fewer job seekers than are could meet that demand. And this is movement toward unemployment rates coming down and employment rates coming up. But I will say there's a lot of churn, and we call it the Great Resignation. An example is in healthcare, there are 11 million posted jobs. There are 6 million job candidates. So it looks like it's in a pretty good state. We have a model where we put together forecasts for the economy. This is the recessionary forecast that we have. It's focused on the US, and I'll say something about international in a second. The blue line is the ongoing, really week by week recession forecast that we produce. And it uses a bunch of inputs and a statistical model. It's pretty good. It over forecasts, it forecasts 10 of the next 6 recessions, but it's caught everything except the pandemic. You can see how, especially for the pandemic, it was nowhere close. What do you look at? Something above 20, something above 30, something above 40 to be worried about. But even if you don't have a recession, this still is indicative of business conditions. So the good news is no recession in sight. The inputs in this Christmas tree-like idea are just many, many different indicators. The indicators are leading indicators around the world from the OECD, from the IMF, in the US from the Conference Board, and then disaggregates, including in the bottom right, consumer confidence. You see, for example, manufacturing new orders and changes in orders, and so on, and just a bunch of data that go into it. These green and red colorings are the recession probabilities. What's your input? And by the way, interest rates go into this as well. What's the net? The net is that right now, at least going into this period with Russia, it looks like there's a 0 probability of a recession. The economy's strong, balance sheets are in good shape. There's about $4.6 trillion sitting in money market accounts that will probably need to go somewhere. Consumer confidence is a little bit weak. It's just about a 50-50 coin flip as to whether we're going to have a recession based on consumer confidence, which probably didn't go up today. But when you put it against the real side of the economy, against the slope of the term structure of interest rates, it looks like the economy is very, very healthy, at least taken as a whole. Now, what does this all say about inflation? This is really the key thing that I've been asked to talk about. Well, headline inflation that includes energy and food and metals has been in the US running at 7.5% and has been a very strong political problem. This is a CPI measurement, Consumer Price Index. Remember that the Consumer Price Index represents a certain, and by the way, this is true in countries, it's true in Brazil, it's true everywhere. Either the consumption basket that consumers hold or purchase leads us to a calculation about price changes weighted by that basket and its components, or from the production side, what producers produce. I want to say one thing. If you're on this call, you probably don't have the same CPI in your own basket of consumption that is inherent in the national average. People in business, asset owners, people in commerce, investors generally have at least slightly, if not significantly different consumption basket. You don't have as much bread. You don't buy as much rice or maize. That is inherent in the index. We think that CPI or inflation surprises often hurt those at the base of the pyramid, those who have low levels of income and wealth, because they're so tied to the basics of life, including energy at your home. But here's the thing, as a proportion, you probably buy even more energy in your daily life and buy more exposure to metals and luxury goods than the average. So your inflation rate probably, even though you may not be hurt as much by inflation, although it comes down to what your business is probably, it turns out that because you are who you are, your inflation is probably higher on a realization basis. The most worrisome trend is not lumber anymore. It's not even home goods. We haven't seen the home good level of inflation that we see today, especially in Florida, by the way, since around 1945. They're really fuel. Over the last year, fuel prices, and by the way, it's not just gasoline, it's transportation and delivery of goods and services that are exposed here, up over 60%. And of course, we saw today Brent reach $105 a barrel. This has given yet more credence to the idea that inflation is becoming more institutionalized. It's becoming more permanent. An academic, if I put my academic hat on, when we think about permanent inflation, we think about literally something that will go to infinity. And, an academic economist has an easy job because permanent really isn't infinite and anything else is temporary. In the real world, we think about 5 years, we think about 10 years, and I'll show you in just a moment the term structure of interest rates and the term structure of expected inflation have continually increased. And while they're still pretty consistent going forward in time, they're much higher than they were, say, a year ago. So inflation expectations have become more embedded in market pricing and presumably in the prices of goods and services. And it's certainly reflecting that way when we look at the surveys. One direct point of connectivity and even motivation is the supply chain. And again, if you are here in this call, you might have a lot of experience with exposure to the supply chain. In any case, the biggest part of the supply chain with respect to the U.S. as a whole is derived from deliveries from China. Of course, now that it is also present even more in Miami than it has been for many years. But historically, LA was really the big input port from China for the US. And especially until the canal got dredged deeper, that was especially true. But still, you can see the change. This is the number of days it takes to get from essentially China to LA through delivery of goods. It spiked up more than 2 times in the pandemic. It's over 100 days. Why? Well, it's not just the traffic of the ships. It's not just crowding in the ocean. It's at the ports. And the real issue is using stevedoring to get goods and products off of the ships into trucks in a world in which there's just a log jam. The number of ships has indeed increased to reflect that. This is in San Pedro Bay on the West Coast at the very end of 2021, at the beginning of 22. There are just under 100 ships waiting to be unloaded. Not all ships, especially the big ones, have cranes that are hosted on the ship. They need stevedoring services. And even if they do have their own cranes, they still need to dock and unload into rail cars and to semis and so on. It's exploded, and it hasn't been this high in a long, long time. Well, this is inducing, along with increases to input prices, energies, as we've talked about, the price of commercial real estate, not in every city, but in most cities, and then labor increases, pushing businesses to hike prices. This is from the NFIB survey from at the very end of last year, documenting the number of businesses that have already raised prices or are planning to raise prices. And you can see, relative to what we've seen in the last decade, we collapsed during the pandemic. Of course, that's logical. And now more than 50% of firms either have already increased their output prices or they're planning to. And so if you put it all together, we're probably in the high 80s, 85% of firms either have or will raise prices. Whether they can or whether they're essentially acting in a group comes down to whether they're in a monopolistic or a duopoly. In the market, like Home Depot and Lowe's in the United States is essentially a duopoly. So price increases are not hard to see. When you go to Home Depot, price decreases are rare, but price increases are rapid, and you're seeing it put in place. Who cares? Number one reason why you care is that this gets expected. it becomes imbued into expectations and imbued into what we call menus. Now today, menus are easy to adjust. Back in the day, it took weeks to print a menu, a wholesale price list, the Sears catalog, menu at the store, the wine list. And by the way, if you've been tracking wine throughout the pandemic, it's already crazy. If you're a wine drinker, you know, you've seen triple price increases in the price of wine. Well, that's a luxury good, right? It has been a period of ongoing changes that have looked like they become more permanent. Now, we know that the so-called soft landing in China felt like it had reverted well before the pandemic. This was in August of 2015 that the soft landing in China impacted the price of oil, along with a bunch of sort of a breakup of the cartel in oil. And so prices were down in the 30s in 2015 and 2016. During the pandemic, they went even lower. And now today we're above $105. There are estimates. It looks like something for every $10 a barrel increase in Brent oil, there's something like a 30 basis point increase in expected inflation that gets passed through to the CPI. Not such a big deal for GDP. It looks like for every $10 increase in a barrel of oil in an average sense, it costs GDP about 5 basis points, or only 5% of a percent. The oil impact is much stronger on inflation than elsewhere. This is even showing up in what the Federal Reserve looks at. You can see this is something that's close to core inflation. So it gets rid of energy and metals and so on. It's been hovering for a long time around 1.6, 1.9, et cetera. And it's just about doubled from where it was at the peak of the pandemic. Why do we care? Well, this is what the Fed looks at. The Fed is now looking at what is essentially a core measure of inflation that has low levels of volatility, and it's had huge levels of volatility. If you look at not just the near term, but let's call it further out in inflation expectations, let's say 10 years, it has been moderate by way of expectations. The change has not been moderate, but it itself has looked moderate. The way this is calculated is taken from financial markets that subtract from the yield of nominal bonds the yield of inflation bonds. The difference being, at least in part, in majority part, inflation expectations is called the break-even rate. It's not exactly the same thing as inflation expectation, because some people say there's an inflation risk that's also a part of it, but it's very close. In other words, this asks and then responds to the question of what is expected inflation over the next 10 years. And of course, we can calculate this second by second. What do you notice? For a long time, going back almost 20 years, you see inflation in the US has been fairly moderate. That means that if you have had a business here, you've lived here, you vacationed here, although it's differential across the country, on average, it looks like inflation has been fairly muted. You can see the max of around, somewhere between 2.5% and 3%. During the great financial crisis, it came down. During the pandemic, it came down very suddenly. And more recently, it's been hovering at around 2.4%. But the challenge that we have is that you may not have a direct relation to that inflation. For example, if you look at, if you're a business owner and you have employees, it looks like wages are up more than 10%. And some say in some industries, they're closer to 30%. You can see that this is the average hourly wage for non-farm US private sector workers, just under $28.50 as of the end of the year. We measured it at $31 per hour. That is it's a sudden and rapid upward shift in inflation induced by wages. Unfortunately, in the Southeast, you're a little bit more exposed to different kinds of inflation. What this graph shows you is the different inflation experiences that we've had so far through the end of 2021, not including what we've seen so far this year across the world. The Mid-Atlantic and New England is on the left. On the right is the South Central Eastern states. So as you go from left to right, on average, Miami has traditionally been on the higher end of the inflation spectrum. More recently, it looks a little more moderated than the central part of the country, which has had some unexpectedly high inflation, in part because guess what? It's harder to get goods and services to the mountain states. And when you have energy appreciation, it affects shipping to Colorado, into Denver. By the way, it also looks like a lot of people are trying to escape taxation in California and moving to Colorado. So the demand for purchasing homes and goods and services and home products and so on and building has gone up, in part the same way it's gone up in southeastern United States and Florida. So who you are matters, what your inputs are and what your outputs are matters, and where you live turns out to matter. For example, and this is just as of the most recently available data from the Bureau of Labor Statistics. It only goes through June, so it's not completely up to date. The average weekly wage increase has annualized, has been dramatically tilted toward the Southeast into California. The way to read this graph is not to focus as much on the 5.4% and above, because it could be well above, but to look at it and understand that in Southeast U.S., in Florida specifically, you often have higher wage inflation than the rest of the nation. So when we're saying the national average, or we're looking at the CPI, where you are and who you are matters. And it looks like many people in Southeast Florida have greater inflation exposures. In addition, if you have wealth, guess what? It turns out to be even more highlighted. That you can see that through surveys. The recent CNBC surveys asked millionaires, and they had two top concerns. This is just at the end of the year. Again, number one was inflation as a threat to your wealth, and number two was dysfunction of government. I think probably government dysfunction is number one or number two always, because it always seems that some government has dysfunction somewhere. But inflation has especially arisen as a concern. Now, are you an optimist or a pessimist? If you're an optimist, then you think that, well, the good news is 60% of millionaires are confident or somewhat confident that the Fed can control inflation. If you're a pessimist, you would say only 60% are confident that the Fed can control inflation. The question is, why do you care? Well, the other reason that you care is, guess what? Luxury goods have had a higher inflation rate than either global or local inflation. Remember, long-term U.S. inflation has been around 2% in expectations. Guess what? Luxury goods have gone at least 150 basis points on average above that. And if you look at some specifics like the prices of watches or the Birkin bags, as you see in the bottom left from Hermes, the real rate of increase has strongly surpassed inflation. Now, the reason I bring this up is because my research assistant did not give me the Birkin bag data. I didn't look at it. You know who told me about the Birkin bag? My wife. and of course, she knows my mother-in-law. And so I think there might be a slight conspiracy at the core of our inflation calculations. And Louise knows that I sometimes bring my mother-in-law into my conversation because she's very attuned to the luxury market. Well, if you are on this and you buy luxury goods, and I just don't mean Birkin bags, I mean artwork or luxury clothes or luxury cars, you're likely to know that this fact is really, really key. Now, why also do you care? Well, you care because although the good news is when the Fed reacts and tightens to try to address one of its two legislated goals, which is price stability and economic growth, which are hard to have at high rates together, right? If you have a lot of economic growth, you have low levels of price stability because you have inflation. Or if you have contractions in GDP, you might have disinflation. The good news is that during many Fed tightening periods, it's in the background of economic progress, and the S&P has a tendency to forecast that. So in a nice chart from Goldman Sachs Asset Management, you can see the last 9 hiking cycles for the US Fed going all the way back to the 70s. The length that the Fed action took place over, ranging here from less than a year to more than 3 years, and the changes in the policy rates that the Fed has access over. On the right is the S&P 500 total return. So the good news is, I guess, that on average, equities have performed well when they're forecasting good times as a result of economic growth connected to economies becoming heated. The challenge, though, is the first line. The first line is in the early 70s, and I'm old enough to remember the early 70s. I remember the oil shock that we had in the early 70s. I remember at the end of the 70s, the Fed reaction to what happened. My students call it the Carter years. Poor Jimmy Carter gets the blame for stagflation. It was a period where we had both a shock to purchasing power in inflation and a shock to growth resulting from the exterior happenings in the economy and the surprise that was a piece of the inflation realization. And I'm afraid that that's what we have today. If we do have that, it turns out it's one of the most deleterious things that we might have in all of economics. Why? Because investors face laws of physics. Now, I'm about to talk about why this matters for you. The first thing is that if you are trying to transfer wealth across time, you always face challenges. One thing is that you have to spend money to live or to give to charity or to buy things. That's okay. That's what wealth is supposed to do, right? Economists always think in units of consumption because even wealth eventually gets turned into consumption somehow. Even in the University of Pennsylvania endowment, eventually we buy something with it. Okay, so that brings down the value of wealth that you hold because it transfers it into consumption. The second thing is inflation, potentially at your rate, not the headline rate, probably above headline. If you own assets, you buy luxury and so on. Taxation, I don't think anyone really thinks that taxes are going to go down, and especially because we have to pay for all of this. One other point, remember, anyone on this call doesn't probably have to be reminded that geopolitics also can represent taxation. I know about the political evolutions in Brazil. Luis knows that I've gone to Brazil probably half a dozen times before the pandemic, meeting people and giving talks and so on. I know about the political gyrations. That represents a kind of uncertainty, a tax to wealth. But I also, holding Brazil aside, I also know what happened in other countries. Not that Brazil is even close to anything, but my family comes from Hungary, which is right next to Ukraine, and Stalin rolled tanks in 1956, not that long ago, through Eastern Hungary, and we often refer to the Stalin tax, which was nearly 98% for my family's wealth, or the Chavez or Maduro tax in Venezuela. Geopolitics can represent a kind of taxation. Sorry. Okay. Then the other thing is that, of course, there are natural pressures on wealth. Marriages, divorces, children. If you run, even if you don't have a divorce and you have just a bunch of kids or something like that, the family tree expands often at a faster rate than wealth. This gives rise to the idea that you have shirt sleeves to shirt sleeves in 3 generations, right? You have wealth, someone produces the wealth, someone uses the wealth. Wealth doesn't grow fast enough by the 3rd generation. It's been watered down. That doesn't necessarily happen all at once. It happens across time. So all these things end up requiring you to do something, and that includes taking risk. The challenge is this, and this is one of the most important graphs that I have you for the whole call. And then I'm going to give you a couple thoughts on it, and then we can open for questions once you see those thoughts about what to do now when we see inflation spiking, and including a potential increase, 8% today in the price of oil. So, inflation expectations should probably be up between 30 and 50 basis points, but between, let's call it 0.25% and 0.5% just today. It has to do with what happens when you have both a growth shock and an inflation shock. I wish I could tell you I created this graph. Actually, it comes from a life insurance organization some years ago, because insurance is about risk management. It's a very important element of risk management. I thought it was so strong that I didn't believe it, and so I replicated it. This is my replication of the following analysis. It's the analysis of 10 different investors who have a certain level of wealth indexed here at $500,000. Now, if you're worth $500 million, all you do is add some zeros, okay? Because it's all proportional. These investors are not risk-free investors. It's not like they're putting their money under the mattress in cash. No, these are investors who are actually investing in what we call the balanced portfolio, 60% equities, 40% fixed income. So baseline, probably too low expected return today to transfer wealth, but it's a baseline starting point. Number two, they're spending 4% per year. It's a retiree example. This is called the 4% rule. The 4% rule says that over a 30-year period in the long history of the US, not up to today, but only through the 1980s when it was developed, if you spent 4% of your wealth a year, you had a 95% probability of making it 30 years in a 60-40 portfolio. 4% per year on average, you have a 95% chance of making it for 30 years in a retirement scenario where you invest in a balanced way. So that makes sense, right? That's why it applies to everybody. Now, again, yields have gone down since what we saw historically. So our challenge today is low yields. In fact, we have negative real yields once you account for inflation. Some people say, well, we haven't had that in 30 or 40 years. No, we haven't had negative yields in 3,000 years. We have data on bonds and bond covenants. This is really unprecedented as such a global phenomenon. What does it mean here with respect to passing wealth? Well, these 10 investors have one difference. They're all starting at the age of 62. They're all going to 92. All that is saying that, you know, you're going to go for 30 years. And these 10 different investors are color-coded. The only difference being that they start in a different quarter. One starts distributions of their retirement in January of 68, another April of 68, another all the way out to April of 1970. This is the period just before the Fed raised rates that you saw. 1972 was that time period, right? 10 different investors. Now, when you look at the graph, you've got to think it's stunning because what it says is if you are so unlucky to have started your distribution, your wealth, you're living off your wealth, you're taking money from the portfolio in July of 1968, I'm just picking one, July of 1968, you didn't make it. Not only didn't you make it for 30 years, you had a declining lifestyle, 4% meant less over time, and you didn't leave anything for your kids. If you were lucky enough to do it, however, started in October of 69, January of 1970, or April of 1970, not only did you leave money for your heirs, 3x what you started with, you had a better lifestyle, and not only did you make it, you made it in style. Right, again, that's true for whether you had $50,000, $500,000, or $500 million. On a percentage basis, it's the same result. And you ask yourself, why? How could this possibly be the case? It's only, you know, a year and a half difference. I mean, how do you think it through? Well, guess what? This happened because in the middle of the time period, we had the oil shock, early remnants, and we had a GDP shock. Unexpected inflation happened, and then we had a growth shock in GDP, and not just GDP, but in the market. We had a downward draft in the market, and we had a shock on a GDP basis. That led to this experience. It's when we have both challenge to GDP or challenge to markets, when we have challenge to purchasing power, it can destroy wealth in a way that is not possible to recover from, even in an entire generation. And by the way, the inflation here, you know, it was substantial, double digits. But even if it weren't double digits, it's still impactful. 7% inflation is not good for your wealth. Now, the two more points to make. Number one, inflation affects asset classes differently. So if you ask me what to do, I want to tell you, well, it's really good to already have been diversified in the past, right? The best way to make it today is to already have diversified. The reason I say that in part is that inflation is really heavy tail. Now, Luis, this is a little bit like being in a Wharton class, okay? So it's a little technical, but it's really important. What I'm giving you is different asset classes, stocks, bonds, treasury bills. I'm giving you the compounded return. I'm giving you the year-by-year average. I'm giving you the volatility, the standard deviation, kind of like what the VIX would measure. Then I'm giving you two statistical measures. You probably haven't heard this since you were in statistics, you know, many years ago, because it's pretty esoteric, but it's called skewness and kurtosis. Skewness is the black swan in one tail of the distribution. In other words, does the statistical distribution of returns that you get from an asset class or inflation, is it symmetric? Is it positive in its tilt, or is it negative? You can see most asset classes over this December 1921 to December 2021, 100-year horizon has been actually positive. Kurtosis is the most important statement. Kurtosis is a statistical construct measuring how heavy the tail is. In other words, how extra surprised do you get even for a given level of volatility? It's kind of very sophisticated. It sounds like ketosis. You know, I'm trying to get rid of my COVID bod. So I'm trying to eat, stay in ketosis and eat no carbs and so on. Ketosis and kurtosis are not the same thing, but they both have to do with how heavy your tail is. And that's what we see for inflation. Inflation has bigger surprises and bigger tails than even equities, than even bonds. It's 12.7. The bell curve has a kurtosis of 3. So it's 4 times the excess surprise. Of course, inflation has low volatility because, prices are generally not, adjusting extremely, but every now and then you get a shock. And that's what I worry. It's a huge surprise. Inflation acts suddenly, and that's what we've experienced. And it becomes unexpected. Now, what's the traditional advice for getting hedges or dealing with inflation? The classical device that we use is to think about deflation, stability, some variance around stability. In other words, slight deflation, slight inflation, something like that, and then rapid inflation. I think we're somewhere in the right two silos. And so what you should have done already, which is not a nice thing to say, but if you're concerned about ongoing inflation possibilities, what you could say going forward is to emphasize real assets. And we know that we saw REITs were up last year. Farmland has appreciated. Gold as a disaster asset as well as an inflation hedge. It's not a great inflation hedge, but commodities generally as a basket are better than others. Cash is a real issue. In part because cash naturally loses value. The only time you should hold cash probably is when you have deflation. Otherwise, you should either neutral weight it or you should underweight. Underweight actually is short selling or using a bunch of leverage. I think some level of leverage, but some level of cash, probably not holding cash today. You should de-emphasize nominal bonds. Real bonds are an issue because TIPS have been issued at a negative real yield. You should probably be de-emphasizing bonds. Now, equities are interesting, in part because you might say we're somewhere between moderate inflation and rapid inflation. So I think probably the right thing to say is to maintain equity exposure. One way to beat inflation is just to make return. The other thing about firms that you hold is that firms by themselves hold real estate and they hold commodities on average. Some of them are short commodities. Most firms in the aggregate use commodity. So you're getting some embedded inflation exposure, but you could also get some volatility at a time like this. If you look at the history of it, the rapid increase period and the disinflation period, I pulled out of Darst. You can see it's 1855 to 1892, it's 42 to 45. The period that we mentioned earlier, the late 60s and early 70s are right in here. That's Vietnam War and the monetary expansion, higher energy prices. It was included in rapid inflation when we had the stagflation period that resulted in the mid-70s, early and mid-70s. And so again, across the board, you can see what happened to the CPI. CPI was about today's level. Equities did reasonably well. Bonds did not do as well as they have historically. And of course, gold and silver and other commodities did well. Cash, definitely, if you look at the history of cash, even in inflationary periods, it doesn't, we treat cash as the risk-free rate. It's not a good way to think about it. If you want to think about what equity classes have done well during periods of more extreme inflation, having made a decision to emphasize equities, You would probably de-emphasize the U.S. to a certain degree. You would probably de-emphasize growth stocks versus value. You would probably tilt towards small stocks, and especially you would tilt toward firms that have high quality management, high quality governance, high quality cash flows, very little earnings management, high ROI, high ROE, low levels of debt, low levels of distress. These kinds of tilts, I think, are important in general. But remember, growth has not been a bad place to be in the last 13 years. If we'll be able to give folks the slide deck, Luis and Maria, I'll send it along. Some of the other pieces that I talk about here, and I'm happy to talk about verbally, are that valuation levels have gotten extreme. PE ratios have gone in fact, PE ratios have gotten so high, I had to draw it off the graph, as you can see. And so I just worry about forward-looking numbers. Maybe we'll continue to have multiples expansion, and maybe we'll have a lot of really good advantage from technology. People going to the cloud, going into Meta, all that might be great. But I just remind you that those very long duration equities where cash flows are far into the future, like growth stocks like Tesla, for example, not to pick on Tesla, Elon Musk, like Louise, went to Wharton, the very long run is involving discounting. If you're not going to get your profits today in the form of dividends, that means they're in the future, and you better discount those back to today some way to judge valuation. Well, if interest rates go up because the Fed raises rates in the face of rapidly expanding inflation, growth has a tendency, all else equal, not to do as well. So this is an historical look. Anything can happen in the future. Past performance is not indicative of future results, but current cash is likely, from a valuation perspective, likely to be valued more than future cash. I think, Luis, that's where I'm going to drop it for you. There might be opportunity for a couple of questions. I'll stay as long as anyone wants. I think the last point is that I'll make is in the right axis. This is the ratio of growth to value as it relates to the 10-year yield. The 10-year yield is in the blue. The growth to value ratio is in the red. Same thing in the upper left. I just drilled down in the bottom right. On average, there's a slight correlation between growth value and interest rates, which of course reflect inflation. You can see here in the last, let's call it, 4 or 5 months, you've seen that correlation expand dramatically. In other words, the correlation of what you do in your investments has become more related to interest rates, and interest rates are now perhaps, tightly connected to what the Fed's going to do in the face of inflation. So I'm going to stop there. I'm happy to say what this really means is that you should be diversified. I think it's hard to be in nominal bonds, to tell you the truth. It's better to be in inflation-linked bonds, but today inflation-linked bonds are issued at a negative yield, so tips are too challenging. And so I think you should be, as ever, diversified across different sources of risk and style. Luis?
Chris, thank you very much for your explanation, your class today for the chamber members. And one of the questions that I have here, if the government spending fuels the inflation, number one, the federal deficit rose 30%. The government balance sheet of the Federal Reserve is around $8.7 trillion. As you mentioned, the whole world went to $17 trillion. So do you think that the inflation is here to stay?
Yeah, I think it is. I didn't show it to you, but if you look at the inflation curve, the expected inflation from the difference between nominal bonds and real bonds, you can see it's gone up and up, and now it's very flat, above 3%. So that's a way of saying it's permanent. Now, it's not permanent at 7. Expected inflation is not permanent at 7. It's permanent at a lower level than that, but it's higher than it has been for a long time. The expectations have between, say, 2 to 3%, 2 to 2.5%. Inflation being at 3 to 3.5, or in the very near term 4%, is an innovation. And it depends what you think permanent is, but 5 years to 10 years feels like a long time. The curve is high today. It flattens out between 5 and 10 years, but 10 years is, a market cycle. It's a long time. So I think it has started to become permanent. I think the Fed's statements were in contraversion to that. I think the Fed's statements suggested a different kind of transience, it's gotten a lot more permanent than that. If you talk to folks in the shipping industry, I have some shipping investments, so I talk to some of these folks. They think that from their perspective, the distribution chain is likely to take 2.5 years to fix. It's going to take that long to fix it. And by that, I just mean the basic distribution, getting goods and services back to the normal velocity of distribution. So we're going to have supply shocks in an ongoing way. And I think businesses have to take advantage of that. They can. And by the way, even if their input prices are not going up and they can pass on price increases, they're going to use it to make profits. That's true. We know that for gasoline stations all the time. Gas stations immediately adjust upward, and then they slowly adjust downward gas prices. Even though gasoline is so competitive in the actual, kind of retail market and wholesale market, I think it's going to keep going. So I think you have to get used to a new equilibrium. Will it be 7%? I don't think so. You might see some spikes though.
Thank you very much. I would like to open for the audience to have some questions. If they have anyone, please open your microphone or send through the chat, please. All right. Okay, Chris, thank you very much again for joining us, taking your time. That I know that your agenda, especially on a day like today, is very busy for you. And I would like to make some announcements now on the chamber side. Thank you very much, Chris.
Thank you. Bom dia, bom dia. Obrigado.
Okay. Larissa? Yes, these are for the members. We have a questions here on the chat. Let me see here. Okay. All right. These are the 10 reasons to become a member of the chamber. And our next event are, let me see here, we have 2 events one for March. That is the workshop that we are preparing, how to increase your business by contracting with the local government agents. We have a lawyer for Wise Sarasota that will come in. They are very big law firm in Florida. Their networks work with the cities, many cities, and it's an opportunity to participate on these seminars because they are going to explain how to do business with the government. The next one is from St. Joseph Institutional Group, Brasil, United States, novos cenários e atualizações. So join us on these events, and I see you on the next event. Thank you very much. Thank you for our team, Mary and Larissa, and the audience. Thank you very much. Have a great day. Bye-bye.
Thank you, Luisa V. Bye-bye.